I learned that a recession is defined as 2 consecutive quarters of negative GDP growth, but the National Bureau of Economic Research is in charge of calling a recession in the U.S., and their definition is much broader. They have stated that a recession is defined as a significant decline in economic activity that is spread across the economy and lasts more than a few months. But while the experts are wrestling to tell us if we're in a recession or not, the fact is, sometimes experts don't call a recession until it's over or almost over. Meanwhile, as consumers and workers and investors, we just know it hurts. We've had 3 recessions since the year 2000 and 13 recessions since World War II, according to the NBER. As a long-term investor, we have to consider that we will see recessions in the future as a natural course of economic action. Here at the beginning of 2023, the concern over a possible looming recession is the perfect time to see just how markets really have reacted to recessions in the past. And while we're at it, let's look at some of the truths versus myths around markets and election cycles. Welcome to the RhinoInvestor.com educational series. Like and subscribe to charge along with us. It's not easy, historically speaking, to not have a recession when the Federal Reserve is raising interest rates to quell inflation like we're having now. So it's natural to spark concern. And that's why you'll often hear the refrain, "Don't fight the Fed." It means don't try to invest in the stock market when the Fed is raising interest rates. But we've also heard and seen firsthand too many times how difficult it is to predict markets in the short term. Markets don't always play by the handbook. If they did, boy, investing would be so much easier. But look at this chart as an example. On the left is each year the U.S. has been in a recession since World War II. The middle shows us how the S&P did that year, and then on the right, how the S&P did the year after recession. Look at years 1953, 57, 1960, 74, 1990, and 2008. Those years reacted like most of us think makes sense. The market goes down during the recession and then rebounds nicely afterwards. But by my math, that's only happened a little less than 50% of the time. This is because the idea of the economic cycle isn't perfect. Peak, recession, trough, recovery is an oversimplified way to understand our economy. Taxation, regulation, spending, monetary stimulus, and a myriad of things can cause the cycle to look different and unique from the last cycle. Reading headlines during recession can convince investors that we're headed for doom. But it's very difficult to know if a coming recession will be quick, like in 2020, or prolonged and painful, like in 2008. So, what's an investor to do? Well, the best step is to prepare before it happens by only taking on as much downside risk as you are comfortable with for when pullbacks and recessions inevitably happen. The next best step is to make small changes in your strategy for dealing with recession risks, like leaning more on consumer goods and healthcare stocks that have fared better during recessionary times. If you have 10 or more years to invest, economic cycles like recessions are to be expected, and if possible, you can use these times as a buying opportunity, like what value managers tend to do. As you close in on needing money from your investments, typically 3 years ahead of retirement, for example, be sure to set aside funds that won't be impacted by market pullbacks. Let's look at election uncertainty next. I've managed money during 8 presidential elections since becoming a financial advisor. And election years, in my experience, have always caused a certain level of uncertainty and angst among investors. Since 1992, 5 presidential candidate winners have been Democrats and 3 were Republican. The popular vote winner lost twice to Electoral College during those years. Once, over 20 years ago, during the closest election in American history, we didn't know the results of the election for 36 days. Remember hanging chads in Florida? Presidential candidates often draw attention to the country's problems, and campaigns regularly amplify negative messages. In general, investors tend to give presidents far too much credit and far too much blame for the health of the U.S. economy and the state of financial markets. Here were the real stock market returns since I've been advising for each presidential term. History shows us that over a long period of time, what party is in control is not the main determining factor in projecting overall stock market performance. Typically, political parties impact certain sectors of the market and produce short-term issues or opportunities in those areas. Since World War II, the larger market as a whole has shown to do well if we have a market government sweep of one party or a mixed government. The only exception being when we have a Republican president with a Democratic Congress. When looking at these statistics, I'm reminded that correlation does not necessarily imply causation, and this is one for the economists and politicians to debate. Another historical theory that has panned out to be somewhat predictable is the presidential election cycle theory. Data on the S&P 500 shows that the third year of every presidential cycle since 1933 has averaged 16.3%. And that's a much higher average than the other 3 years by far. As we know, past results are never a guarantee of future results, and unique events can change outcomes. But the theory does have some merit as a bit of a self-fulfilling prophecy, because in my experience, investors tend to hold out on buying before midterm elections and invest once it's over, no matter the outcome. In general, if you have cash to invest right before midterm elections and you want to wait until it's over, there are no guarantees you'll get better prices, but you do have history on your side if you decide to wait. As always, it's best to keep your long-term strategies in place at the core and use smaller amounts of your portfolio to lean into areas that may do well after elections are concluded. I hope this video has helped give you some perspective on how recessions and elections have impacted markets in the past. Because when negative headlines start in earnest, it's not always easy to stay balanced and focused on the longer-term goals. The more you learn, the more you're on your way to becoming a Rhino investor. Keep going in this series and see the past impacts of inflation and interest rates on our investment accounts. See you there.